Wasting money on cures. Forgot how to fix myself. They say that time is free. Then why is it so precious? Oh, I'll say memories in my head, like Polaroids on walls. They remind you to look ahead. Time is running out. Time is running out. Lately I've lost my track. I've sailed the deeper seas, hoping to find something to bring back better times. Oh, I'll say memories in my head, like Polaroids on walls. They remind you to look ahead. But time is running out. 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 Time is running. Time is running out. But time is running out. What if my best days are over? They can't be over. They can't be over now. Time is running out. What if my best days are over? They can't be over now. Time is running out. Time is running out. Time is running out.
Hi, good evening. Welcome to the 10th and final in our series of autumn live streams. We take a key topic or an exam skill and we just spend 20-25 minutes looking at some questions, some previous paper multiple choice questions, basically doing some solid revision, put those minutes in the bank ahead of maybe mocks later on this term, perhaps, or early next term. Welcome if you're joining us live. If you're subscribed to the channel, you can contribute to the discussion, and we always have some great answers which we'll do our best to showcase as we go through the session. Tonight, key topic is monetary policy. You know, you're always going to be talking about this kind of stuff in your exams, so hopefully this will be a useful session. We're going to focus on two countries today, the UK and a country yet to be announced. Before we crack on, a reminder that next week we are on Strong Foundations, going around the country. I'm looking forward to being in Leeds with people a week tomorrow. Let's start with the big reveal. Good afternoon to everybody joining us. 5 clues about an economy. Let's see who's the first person to get this right. Here we go. My main exports are dairy, meat, and wine. Pretty nice combination, that one. Many comes in straight away with Greg's. Yeah, we're looking for a country rather than a business, but pretty close. Second clue. My central bank was one of the first to use an inflation target. This goes back actually, 35 years. 35 years. Do the maths, Geoff. So this country is one of the first to bring in central bank independence and an inflation target, which we're going to talk about today. Number 3, geographic isolation creates significant transport costs. So you think about the world economy, the globalized economy, dairy, meat and wine, but with significant barriers in terms of transportation costs. Clue number 4 is coming up on your screen now. A bonfire of farm subsidies revolutionised the agricultural sector. If you go back 30 plus years, this country is one of the first to essentially get rid of traditional farm subsidies. And there was an initial big sort of displacement effect. Out of it came much bigger farms operating at scale. And clue number 5, this country has one of the lowest corruption indices globally. That's Transparency International that does that, therefore helping to attract high trust FDI. By the way, if you're doing your year 13 macro, you're studying development economics or globalization, economists are now talking about high trust FDI, not just, whatever, assembling cars and whatever it is, but this is FDI, which is built on political stability and a low level of corruption. Okay, lots of you saying it's got to be New Zealand. We think the AI, Wellington Mini, but others, Will Carver came in and Z0RBS came in with New Zealand. Really interesting economy to study, and one well worth keeping an eye on. Well done, everybody. Here's our usual mix of multiple choice. These are all taken off past paper questions from the last 2 or 3 years. Let's see if you can get 5 out of 5 on monetary policy. Diagram shows a long and aggregate supply, and AD for an economy. Initial equilibrium is point X. Which combination of monetary policies will shift the equilibrium position to point Y? What do we think here? So we're looking for a combination of 2 types of monetary policy. Let's see how strong our A-level economists are today. Welcome to those joining us live. Our good regulars are in tonight. They always make an amazing contribution through the chat window. The consensus seems to be C. Let's double check. It is C, yeah. Some sort of quantitative easing there to increase the money supply and a decrease in policy interest rates. Keep scores, but I'm not taking your papers in tonight. So can you all please keep your own scores online as we do it. By the way, if you're watching on replay, as hundreds of people do, just press that pause button if you fancy a few more seconds for each question. Question number 2, to counter deflation, central bank uses expansion in monetary policy. What is likely to result? So what do we think here? Higher cost of borrowing, an increase in commercial bank lending, an appreciation of the exchange rate, an increase in the cost of servicing government debt. What do we think? To counter deflation, central bank goes for an expansion in monetary policy. Keep an eye on the chat window as the answers come in here. A couple of differences of opinion. Some people are going for A. Well, that will be a deflationary or contractionary monetary policy. The cost of borrowing goes up. And I think Sienna and others and Kronos have got the right answer. The answer is B. Yeah, you'd expect cheaper interest rates to feed through to more lending if supply responds to demand. It's not C because other things being the same, expansionary monetary policy would cause a depreciation of the exchange rate in a floating system. Let's try question 3. Bank of England's Monetary Policy Committee raises official bank rate. Okay, we see the following channels of the monetary policy transmission mechanism is most likely to have the biggest contractionary impact on AD in the short run. I like this question. This is quite subtle. So the central bank's increased interest rates, everybody. Which of those channels is likely to have the biggest contractionary effect on one or more of the components of AD? Is it the wealth effect? Is it the borrowing cost effect? Is it the trade effect? Is it the exchange rate channel? What do we think? Take a moment on this one. If you're watching live, do post an answer in the chat window. We love the contributions. They are sensational. Most of you, I think, are getting it. Even Jim in the production room thinks it's B. Let's double check. It is. Okay, it's sometimes called the market rate channel. The cost of borrowing goes up for both firms and consumers. And Jim is punching the air, as we speak. Little victory there for Jim with his question 3. Question 4 coming up. Oh yeah, this is a good question. This was from 2024. Which statement best describes the primary mechanism and objective of the Bank of England's quantitative easing policy during a period of low inflation and near zero interest rates? So we are getting lots more questions now on QE. It's on your spec, particularly if you're in the UK. Which statement best describes the mechanism and objective? Mechanism is how does it work? Objective, what's the aim? Okay. What do we think? Have you revised QE? I hope you have. We've got some great students in this chat. It's about outstanding students, a bit like my debt. Outstanding. Most of you going for A, let's double check. Yes, buying bonds, corporate bonds. Turned out it was mainly government bonds, but injecting liquidity into the banking system to bring down interest rates and to boost asset prices. Final question, keep your own scores, but I'm not taking your papers in, so please keep your own scores. Which of the following, this is a great question. Which of the following is the most significant constraint on the Bank of England's ability to use monetary policy to help stabilise the business, sometimes called the economic cycle? Quite a few words here. A few people arriving late. It's great to see you. There's no need to apologise. But you're very welcome. Which of the following is the most significant constraint on the Bank of England's ability to use monetary policy to help stabilise the cycle, to reduce the amplifications and the volatility? Answers are coming through here. Lots of you so confident you're posting it twice. Good stuff, everybody. Yep, let's double check. The answer is D. The existence of variable time lags between a policy change and its maximum or final impact on inflation and output. Excellent. Right, okay, scores on the doors, please, everybody. That's our 5 multiple choice. As always, we always have some multiple choice questions. Can you please post your scores on the doors and we'll showcase? Wow, well done to Terry. Yep, Ash got 4, Minnie got 5. Well done, this is superb. Great stuff, everybody. By the way, if you got 5 out of 5, then that's 100% according to my scoring system. Well done, everybody. Most people are getting 3, 4, or 5, which is reassuring. The last 2 or 3 questions there weren't easy, actually. Kadzai, of course, coming in with 4. Minnie's on fire. Let's move on. Okay, so we're going to focus again. We always, in our little sessions together, we always take 2 little case studies and I ask you some questions to revise, and then I'll work through some answers and some ideas with you. Let's look at the UK. First of all, here's a key chart. A chart I update every month. Keeps me busy. Better than having a job. So you can see there the inflation target is 2%. Central bank interest rates, a little histogram there. That's what's happened to the policy interest rate set by the Bank of England. Inflation in blue, that's CPIH inflation. So it's a little lower than the peak in CPI inflation, but you can see what happened to inflation in recent times. But notice that inflation's been above target, well above target, since 2021. That is, if you want to add 1 line to your notes, revision notes, as an examiner, I mock thousands of answers every year. And if I read a student saying, well, actually in the UK, inflation's been well above target for over 5 years or 4 years. In fact, inflation now twice the target. That kind of knowledge and understanding is outstanding. So on the basis of that data, here's a little challenge for the group. Can you offer me 1 or 2 reasons why a central bank might decide to allow inflation to stay outside target range for a length of time? Let's run a clock on this. Let's see what we can come up with. It's not axiomatic that the central bank has to raise interest rates when inflation's above target. So why? Why might a central bank decide to allow inflation to remain outside target range for a length of time? This is a tough question. In fact, a couple of the questions tonight are super tough. So let's see what the group can come up with in our time together. Wow, absolutely. A desire to not threaten or undermine economic stability. Okay, Kronos. I mean, there's some great answers coming through mentioning shocks. Here's Kronos says, the point from Kronos, prioritize other objectives. In a recession, a government might, nice hedging word there, Kronos, might deem it best to potentially reduce interest rates. Central bank rather than government, for example, but of course the government might be setting interest rates in other countries. Amarja came up with a lovely point, just came into the chat window actually, and what we can find it. The desire to boost AD in America, where Trump wants to boost domestic demand, trying to force the Federal Reserve to change rates, so might ignore inflation temporarily. Absolutely. I think many came in with a point about external shocks can temporarily cause inflation to move beyond. Yeah. By the way, as we give a little bit more time, some great answers coming through the chat window. Absolutely outstanding. Here are my 2 points. This was a tough question, by the way. In fact, all the questions tonight are pretty tough. Yes, I think the main reason is probably depends what's causing the inflation. So inflation often is caused by external supply side shocks that are simply outside the Bank of England's control. The Bank of England doesn't determine world price of gas. Bank of England doesn't predetermine geopolitics. So we've had post-COVID supply chain disruptions. We've had currency depreciations. We've had obviously the Ukraine-Russia war. We've had a big rise in the cost of global energy, all those kind of things, El Nino. A lot of the factors affecting inflation are not in the control of the central bank. That's, by the way, a great line for your notes. Many causes of inflation lie outside the central bank's control. A-star evaluation. You don't have to go on TikTok to hear that. That is A-star evaluation. And also time lags. So the Monetary Policy Committee must set policy interest rates now, currently 4%, based on the current forecast of inflation in 2 years' time. So if they try and hit the 2% target today, they may well destabilize the economy. Today's inflation reflects past conditions, not just current policy. But looking at the chat window, if you have a moment, those of you joining us live, do look at the chat window. One of the great joys of our group, and it's going to grow and thrive in 2026, is just the quality of the answers coming through. So thank you for those. Let's move on to the next little challenge. Can you give me, this is evaluation, can you give me 2 factors that might make a policy of cutting interest rates less effective in meeting macro objectives? Let's run the clock. Very common exam question this, everybody. When might monetary policy become ineffective? And those of you who are really on this will know this links to something called the liquidity trap. Great point there from Terry, really good. Yeah, animal spirits comes in there, good. So far we've got the confidence factor. Quite a few of you mentioning that, which is good. Nikita comes in about the reluctance of the commercial banks to actually lend out. Risk-averse banks, very good. Sienna's describing there the liquidity trap, essentially, beautifully done. If households and firms lack confidence in the economy, they may not borrow or spend even when interest rates are low. Yeah, absolutely. And some good points there about low interest rates means the cost of borrowing decreases, but also can reduce the return on investment. Yeah, I think there's a good point in that. Well, that said, the opportunity cost of investing is probably lower because you're not going to get the same return on your savings. But most of you are focusing on confidence, but Minnie came in with this point about debt. So really, a couple of really points, high levels of debt. I think that's a great point. Here are my 2 arguments running through. Fixed rates. I think Jim in the office, he must be on a fixed rate mortgage. He talks about fixed rates. This is interesting. The UK mortgage market, about 80% of all new mortgages are fixed rates. Fixed rates. In other words, you take out a loan for 2, 3, 5 years. There you go, Jim showcasing his own answer. And so people have locked in. Well, lots of people lock in, especially year 11s doing their revision, but you lock into a fixed rate for 2 to 5 years, sometimes longer. So a short-term base rate change doesn't really affect you. It's only when your deal expires that you get the benefit of a cut in interest rates or you get the pain of an increase. Oxy's locked in, no question about it. Now, interestingly, the one person last year who took out a variable rate interest of a 2-year variable, there's only one person in the UK, the entire UK, only one person took out a variable rate mortgage last year, and it was me, because I was expecting interest rates to fall below 4% by the end of this year. So I've got one more month left. And the other point is debt. This is a really good point. Quite a few mentioned it. Debt levels are high. We're going into the next stage of the cycle with a lot of people with mortgage debt, consumer credit, corporate debt, local authority debt. Okay, so typically then people think, well, okay, my main priority is going to repay debt. Hence, and hopefully you've done this economics, the marginal propensity consumer at any little increase in your income is low because you're basically going to repay debt instead of spending it. So bring in MPC, bring in disposable income there. And thank you to Nikita for a utterly superb definition of the liquidity trap. People have, even low interest rates does not incentivize them to spend further. They're looking to rebalance their balance sheets, improve their finances before they're willing to go make that big ticket purchase. And that could take several years. Wow, this is great. Let's crack on then, conscious of time. Again, I'm just trying to test your evaluation skills here. Can you give me 2 ways in which a period of higher interest rates might conflict with other macro goals? Have a go. So when might monetary policy conflict with other economic objectives? Have a go. These are tough questions tonight. What can you come up with in a minute? Terry's point there is about the impact of higher inflation. Terry, I'm really asking about higher interest rates rather than higher inflation. Yep, X there from Sienna. Well, yeah, some good points coming through about the exchange rate and trade, and the macro goals such as low unemployment may suffer due to higher interest rates, causes firms to invest less. Therefore, the jobs that are being created are minimal. This is good stuff. And this is a really good evaluation point that monetary policy doesn't always work in sympathy with or in chiming in with other macro policy goals. Good stuff there from Marlowe. Higher rates mean higher borrowing costs for consumers and businesses, potentially causing lower spending and investment, which would diminish growth. Another government policy. Absolutely. Nice link, neat link there between monetary policy decisions and the ultimate objective, growth and living standards. So most of you getting that nice link between interest rates. Great answers, brilliant answers. I've gone with growth and jobs, and I've gone with balance of payments. Marcel, Geoff, this is pretty obvious, but it's important. So if interest rates go up, in theory, you get a fall in planned investment. Projects at the margin become less profitable, and the housing market takes a hit. So there might be a trade-off with growth. And I've also gone with the balance of payments. A couple of people did that, which is really good. Have you done exchange rates yet? If interest rates go up in the UK, that can cause an inflow of hot money, short-term capital flow, causing the exchange rate to appreciate. This then makes exports relatively more expensive. Imports become cheaper and might cause the trade balance to worsen, which will have a negative effect for the current account and also for the growth rate. Great stuff. Wow, we're doing really well here. Let's finish off with, we're only doing 25 minutes tonight. We're having a short session. Let's look at another country. Okay, yeah, balance payments is a really good one. Most students wouldn't mention, actually. I think the students who mention the balance of payments impact are really bang on it. Here's a chart. I've put the UK interest rate there in there. Can you see that? 4%. I then put interest rates in India, a bit higher, the UK, but look at Brazil. Interest rates in Brazil now 15%. Now, your exam was set a year ago, So, and interest rates in Brazil were really going up very quickly a year or so ago. So from a development monetary policy perspective, all kinds of different reasons, actually, Brazil is a great country to study. But keep in mind that interest rates in Brazil, the policy rate is 15%, whereas in the UK it's 4%, in India just under 6%. So there's the backstory. Here's my question for you. It's my final question tonight. Now this is a really good test of your economics. Can you give me 2 reasons why policy interest rates in Brazil are much higher, a lot higher than in the UK? Have a go. Why might interest rates vary so much from country to country? What's the economics behind that? This is almost like a meeting of development economics meets globalization meets monetary policy. Yeah, some great answers coming through, and thank you to everybody who takes the time and the thought to contribute there. Terry says that Brazil might be experiencing hyperinflation. It isn't, but it does have much higher inflation, and it's a higher inflation target. But actually, you're hitting a really good point there, Terry, that the Brazilian currency, the real, was introduced to try and restore inflation price stability, because Brazil has a history of very high unstable inflation. Lots of great answers there. If we can go to Minnie's point, has a great sort of claim to be student of the day. Higher inflation and inflation expectations in Brazil, and weaker financial stability. And I think Kudzai comes in with this point about the higher target is a reflection of the instability in the financial system. I'm going to give you a concept here to add to your notes, if that's okay. So here are my 2 answers. I've gone for, first of all, high inflation expectations. The biggest determinant of interest rates being high is the need to control inflation, ultimately. And if you have high and volatile inflation, which Brazil does have, inflation is more persistent. Inflation expectations are anchored, well, less anchored to the target. They're more embedded at a higher level. So you probably need higher interest rates to nip the inflation in the bud. And then really drawing on Kudzai's point, I'm calling it the risk premium. So basically the interest rates you charge act as the price you pay to attract and retain global financial capital, hot money. Okay, Brazil doesn't have the same credit rating than, I don't know, Japan, the UK, Germany. There's a higher risk of sovereign default from debt, both corporate and government. Investors therefore need a risk premium if they're going to hold Brazilian government debt or corporate debt, and there's an insurance against that high inflation and the currency volatility. So it's you can't really imagine a situation where Brazilian interest rates were considered high at 4%. They probably need to operate, their normal interest rate is probably between 8 and 10%, much higher than the UK. And that has consequences for the Brazilian economy. But of course, you need to look at the real interest rate, which is the nominal interest rate minus inflation, to see what the impact on Brazil is. But what we're trying to do is we're just trying to test your understanding of monetary policy in different countries. Okay. A question coming in: did you know, guys, that Japan has over 200% government debt compared to GDP? I did know that. It's actually 256% according to the latest IMF data. But interestingly, Japan has very low interest rates, just under 1%. And although Japan has a huge government debt, the cost of servicing that debt is quite low relative to GDP. Whereas in the UK, we have a debt of 100% of GDP, but our bond yields are 5%. So it's costing us £2 billion a week to pay the interest on the existing government debt. Now, a couple of things. One is we are back on the road next week. We start our Strong Foundations tour, visiting different parts of the country, from Birmingham to Manchester, Leeds, and London. Very busy week in London coming up, the week after next, I think. And secondly, the budget is coming up at the end of November. It's going to be a big one. I think it's going to be one of the most consequential budgets, certainly in your time studying the subject in my recent memory. So look out for that. That's the end of our series of 10 live streams just in this little block. And I think there's quite a few of you been to all of them, which is amazing. So thank you. We go again in the new year. We have a whole series of live streams, regular live streams in the new year, as we lock in and focus on the exams. So don't worry too much. We'll be back bigger and better as we go forward into the new year. As always, thanks to all those people who've joined in and contributed so brilliantly. Oh wow, great news! Can we have an online applause, please? Send your messages of congratulations to Kronos. He's got an offer to study economics at Southampton. That is brilliant news. Great news. What's the offer? Can you tell me what the grades are, please? What are the offers coming through? That is great news. Fantastic. Now you've got every motivation to absolutely smash it in the year ahead. There we go. 2 A's and 2 B's. Well, if the answers in this live stream anything if you do the same in the summer, you'll be absolutely in great shape. Well done, everybody. Thanks for joining in. Spread the word about our channel. And if you enjoyed the session, consider pressing that like button and the subscribe button. But most of all, stay happy, stay healthy, stay curious, and we'll see you all soon.